Hello everyone, warm welcome to Testbook Super Coaching. My name is Madhav Sir. I welcome you all in your favorite series, that is Basics of Finance. If you remember, in the yesterday's session, we have started our discussion on a term that is financial market, and today we will be moving ahead and we will be discussing in much detail the financial market itself. Today, our agenda is primary market as well as secondary market. In the previous session, I have given you an outlook that how does a primary market looks like, how is secondary market, but today we will be discussing in much detail. In case of primary market, we will be discussing the financial institutes which participate in financial market. Will discuss the important terms related to financial market, specifically primary and secondary side. So let's start the discussion without any further delay. But before I start the discussion, may I have a reply in the comment section that I'm audible, visible, everything is fine, we are good to go, so that we can begin the discussion without any further ado. Now, if I say primary market, you need to understand this point very carefully, that what basically primary market is. And if I try to make you understand this particular point, what I'll do is I'll take an example to explain the entire flow. So please pay attention. This is going to be interesting and I'm pretty sure you're going to enjoy this. Let's suppose, guys, there is an organization named X. This organization wants to register itself and wants to issue the shares so that it can raise the funds. So what will be the first step? The first step is, Sir, X will register itself as a company. So the moment an organization wants to register as a company, the organization will be reaching out to registrar of company, and once they reach to the registrar of company will look forward with a number of nitty-gritties, the eligibility, qualifying conditions, and once everything is final, then the same organization will be termed as company under Companies Act. Under Companies Act 1956, and it was amended a number of times. The latest amendment, I would say, is 2030. Now, the moment you decide that yes, you want to set up a company, the first thing which is going to ask from you is what type of company you want to set up. So what you're trying to say? Then what I'm trying to say is we divide the company into different categories. The first, we divide the company on the basis of share issue. We divide the company on the basis of share issue, or we define the company on the basis of share issue. And secondly, we define the company on the basis of ownership. We define the company on the basis of ownership. Now, I'll start with this part, ownership part. That is easy to understand. I'll start from here. So how you define a company on the basis of ownership, then what will be my answer? So we have two types of companies. One, we call it as privately owned. One, we call it as privately owned, and second, we call it as government owned. Second, we call it as government owned. And third could be defined on the basis of the shareholding only. Let's suppose there is a company which is a joint venture of government as well as private, but the decision will be taken up on the majority shares. If 51% or more shares are with you and me, then it will be a privately owned. If it is with government, then it will be a government owned. So this is on the basis of majority. And what I mean by the term majority, sir, I'm talking about majority shares. If they are greater than 51%, on that particular basis, we decide the ownership. So it's easy. It's easy. Why you are discussing it? I have an answer for this. You know what? When we define the company on the basis of shares issued, then we say one as private company, and the other one we call it as public company. Generally students, they get confused or they have this notion public company means government company. No. It's not government owned. What is the difference? Sir, it depends on the, as I mentioned, shares issued. In case of private company, limited number of shares are issued. or we have limited number of shareholders. That would be a better term. Limited number of shareholders. In case of company, bare minimum we need 2 shareholders and maximum can be 200. But these days we have a condition that we can have 1-person company as well, where one individual can be the owner of the company. But in general, minimum shareholders are going to be 2 and maximum shareholders are going to be 200. And in case of private company, the private company issue its shares not openly to the public. Everyone cannot invest openly in these companies. These companies, they approach to raise the funds from the investors and we call it as private issue. What we call it as private issue. And how we identify that whether the company is a private company or public company, then the answer is, if it is written in this manner, X Private Limited, that means I'm talking about which company? I'm talking about private company. And if it is written X Limited, then we call it as public company. Now, please make this point very clear in your mind that public and private has nothing to do with the ownership. For example, you might have heard about Bharatiya Reserve Bank Note Mudran Private Limited. Bharatiya Reserve Bank Note Mudran Private Limited. What is it? So this is the subsidiary of RBI. So RBI is a government owned company and RBI has set up its own subsidiary, but we call it as a private limited company, which means this company is a private company. It has limited number of shareholders and its shares are not issued to the public, but its ownership is with the government or government organization, or this institute is owned by government. Are you getting my point? On the other side, if I say Infosys Limited, sir, Infosys Limited is a public company because in case of Infosys Limited or in case of public company, minimum shareholders are going to be 7 and in case of maximum we have no limit. In case of maximum we have no limit. So the company which issues shares openly to the public, and you and me, everyone, if we fulfill the criteria, that means we have the demat account and we can apply for the shares, and if we receive those shares, we will become the owner of the company. So Infosys Limited, what is it? Sir, it is a public company but privately owned. Are you getting my point? It is a public company but privately owned. In the Reliance Industries Limited, sir, it is a public company but privately owned. On the other side, if I say Coal India Limited. So Coal India Limited, again, it is a public company because shares are issued to the public, but majority shares are with the government. So we say Coal India Limited is also a public company, but government owned. Are you getting my point? Are you getting my point? This understanding is really very important. Until and unless you have clarity on this concept, you won't be able to understand the nitty-gritties related to the company. Can you say yes, sir, in the comment section, please? Can you please say yes, sir, in the comment section if this point is clear? Because without understanding this concept, it will be impossible for you to understand the session further. Got it? Now, if I take some more examples, for example, I say Reliance Industries Limited. So, as the name suggests, what is it? Sir, it is a public company. That means its shares are issued in the public. These shares are shares are issued to the public and it is privately owned. What is the meaning of privately owned? So privately owned means that majority shares, more than 51% of shares are with you and me. It's not with the government. It's not with the government. Got it? Clear? Moving on to the next side. On the next side, the same example as I took earlier, Reserve Bank, Bharatiya Reserve Bank Note Mudran Private Limited. So what is this? So this is what? Sir, it is a private limited company, which means it's a private company. It has limited number of shareholders, but it is government owned. If you don't want to use government owned, we can say that it is owned by government organization or it is owned by government company. This is the difference. This is the understanding you need to have. Now, if you want to set up a company and you got yourself registered with the registrar of company, in general, not always, but in general, you will get a chance to register yourself as a private limited company only because SEBI do not want to risk the funds of the investors in a new company. So SEBI generally allows a new company first to set up as a private limited company, then operate, then we'll see that whether we'll allow you to go public or not. Best example would be Zomato. When it was set up, it was a private limited company. Later on, it got a chance to become public company, and then Zomato issued its shares to the public and it became a public company. Similarly, Paytm, you might have heard about it. You might have heard about the term IPO. So that is related to the same that is related to the same concept. Let me try to make you clear the same concept. Please pay attention. So as I said, X is a firm, it is an organization. It reaches to registrar of company, and finally it is registered as a private limited company. It is registered as a private limited company. X was looking forward to register directly as a public company, but unfortunately SEBI has not allowed, and SEBI said, if you want to start your business, please start as a private limited company. It said okay. So in this particular case, the owner of the company, the founders of the company, they will invest the funds, and if they need funds, what they will do, so they will go in a situation where we call private issue. Private issue means they will be going to the investors whom they know, or by any channel they meet them, and then they explain the working of the company, they explain the entire agenda behind setting up the company, and they raise the investment against the equity. Equity means against the shareholding. So in this manner, they start operating. In this manner, they start their operation by private issue. Once the company has started their operation with private issue, in that particular case, company will work for few years. I'm just taking an example. There's no hard and fast rule. There's no minimum criteria over here. Let's say after 5 years, company is doing pretty well. After 5 years, company is doing pretty well. Now this company wants to register itself as a public company. Now this company wants to register itself as a public company. So what they will do? So they will be coming up with a proposal. They will be framing a proposal. We call it as red prospectus. They come up with a proposal. Don't get into these technical terms. I'll explain you these technical terms. Let's say they will frame a proposal and financial status. What I mean with the term financial status, so they will start in this manner, that we have founded this company in so and so year. This is the investment we have raised till date. This is the equity structure we have, and now we want to go public. And this is our future aspect. This is our future target. This is what we are thinking to do in the near future. Now, SEBI will go through with the proposal. SEBI will go through with the financial status, and then SEBI may approve or may not approve a company to go public. Now let's suppose SEBI has given the approval that okay, you are doing well, now investors can invest in your company. We are in a situation to approve your call for going public. We allow you. The moment SEBI allows you, then the same company which was earlier X Private Limited, now this company will become X Limited. Now this company will become X Limited, and this company will issue the shares for the very first time to the public. Issue the shares for the very first time to the public, which we generally call IPO. IPO basically means initial public offering. That means when you issue the shares for the very first time to the public, that process is basically termed as IPO. That status is basically termed as IPO. Is it clear now? Now, the moment company gets approval that yes, you go public, there are n number of channels through which the company can go public. Let's suppose I am a company, I want to raise funds, but it's not possible for me or my founders to go home to home and press the bell and let the individual come. Hello ma'am, hello sir, I am founder of so and so company, we are going public, would you like to purchase the share? I'm not a salesman, I'll not do that. I hope you're understanding. Then in that particular situation, what should I do? Sir, I should sell my shares where the public is already trading in shares. For example, if I'm selling my share in a vegetable market, do you think it will be a fruitful call? No, everyone is coming to purchase vegetables. Why they will purchase my share over there? Mindset is different, thought process is different, and agenda of coming into that market is different. So in that particular case, a company will approach either to a financial institute, or it may even approach to the stock exchange. I'll explain this concept of stock exchange later on. Let's stick to the term financial institute. Let's take an example to understand this in a better manner. Let's suppose the financial institute is SBI, State Bank of India. So I tied up with State Bank of India and I said, please sir, on my behalf, you issue the shares to the public. You have a good customer base and you are already working in the financial world. The one who is coming to invest, that means deposit their funds with you or to purchase n number of your investment portfolios, give them an option that a new company is coming. If you are interested, you can go for it. So the moment SBI will come in the picture, so SBI will be working for obviously commission basis, that if I will be issuing the shares of your company, then I will be trying to earn profit. I will be trying to charge commission in this issue, and that commission will be called as issuing cost. That will be called as what? So that will be called as issuing cost. It will be included. In the expenditure side of the company, that will be termed as issuing cost. Now at this moment, SBI may reach to the customer through newspapers. SBI may reach to the customer through its website. SBI may reach to the customer through its n number of branches all over the country. Whatever possible, they will try to inform the public about the X Limited company. Now, there is a procedure. I'm talking in a layman terms and I'm talking about the early days, not in the current scenario. Earlier, what was the situation? So earlier there was a situation that every investor will be asked to fill in the application. That if you are registered, fill in the application. Once you have filled the application in a given timeline, then issuing will be done. Now let's suppose company wants to raise funds of 100 crores where the face value of each share is 100 rupees and the number of shares is obviously what? So that is going to be 1 crore. Now there could be a situation that against this 100 crores, which I call it as issue capital. What is issue capital? The capital against which company is ready to issue the shares. Against this issue capital, we may witness applications more than the issue capital or less than the issue capital. So that applications which we receive, that is known as subscribed capital. So what is subscribed capital? Sir, in order to purchase these shares, the value of applications which have been received, that is known as subscribed capital. It may be more than 100 crores, it may be less than 100 crores. Once the subscribed capital is received, then issuing ratio will be checked. Then we check what? We will check the issuing ratio. Let's suppose subscribed capital is 200 crores. Subscribed capital is 200 crores. And what is our issue capital? Sir, issue capital is 100 crores. So what is going to be the issuing ratio? So issuing ratio is going to be 1:2. That means who has applied for 2 shares, he may get 1. On the other side, it can be less as well. But whatever the case is, on the basis of the subscribed capital and issuing ratio and issuing capital, shares will be allotted. Now the question is, sir, how come selection is going to be done? So selection is going to be random. It's a random selection. It's not a case that if subscribed capital is 400 crores and issue capital is 100 crores, everyone will get 1/4 of the shares for which they have applied. That is not the case. What you will get is, it is kind of a lucky draw system. If you are selected, then the shares will be issued. If you are not selected, then your funds will be paid back. Are you getting my point? But nowadays things have changed. Because now there is no need to reach to the branch to apply or to fill in the application in a physical mode. So you won't be filling in the application in a physical mode. Everything will be done in a digital mode. So in a digital mode, what you will do, So you will apply for this IPO. That means you will be filing the application. Now the number of days to file the application, it can be 5 days, 10 days, 15 days, depending upon the company's scenario. Depending upon the company's scenario. And when you apply, there is a term which is known as ASBA. There is a term which is known as ASBA. Now the question is, what is the meaning of ASBA? It stands for application supported by blocked amount. Application supported by blocked account. So what does it basically means? See, you have a demat account. What is a demat account? So these days shares are available. These days shares, they are available in digital mode. They are available in PDF form. They are available in digital form. No physical shares are traded. No physical shares are traded in day-to-day operations. If no physical shares are traded in day-to-day operations, then if you want to purchase those dematerialized form of shares, you need a demat account. So it's a kind of account where the shares which you are going to purchase, they will be stored for you, or they will be stored at your account. And these demat accounts, they are linked with your bank accounts. They are linked with your bank accounts. So the moment you click on application, so this application is going to be application supported by blocked amount. What does it mean? It means, let's suppose the company has said that minimum lot for which you can apply is 1000 shares, and each share face value is 100, or each share's value is 100. I'm not getting into this because you may have the premium value over here. I'm not involving that. So your lot price is going to be 10,000. The moment you apply for this lot, simultaneously your bank account, from your bank account, 10,000 rupees will be locked. 10,000 rupees will be locked. What I mean with the term locked, the moment you check your account balance, that will be 10,000 less, but actually funds are not debited. They are just logged in your own account only. They are locked in your own account only. And then once the application procedure is completed, once the issuing procedure is completed, if the shares are issuing process is completed, if the shares are allotted to you, then in that particular case, amount will be debited. It will be practically debited, and against this debit, shares will be credited in your demat account. Shares will be credited in your demat account. So this happens in demat account, and this happens in your bank account. But unfortunately, if shares are not allotted to you, you are not the lucky one. If shares are not allotted to you, then in that particular case, no debit, obviously no credit. Why no credit? Because the amount was not debited earlier. So no debit, amount will, or that amount will be start reflecting in your account. So your account will reflect that 10,000 rupees, and the shares are not given to you. So no shares will be credited into your demat account. So this is how the entire process falls out. Is it clear now? Is it clear? So what is ASBA? That should be clear. What is demat account? So demat account is an account which is offered. Demat account is an account which is offered to an investor who wants to invest in the shares, because these days shares are available in the market in dematerialized form, and if the shares are available in the dematerialized form, you need an account where those dematerialized form shares can be credited and debited. Got it? Clear now? Is it clear till this point? Say yes sir in the comment section. Thank you so much. Now, in this entire process, n number of financial service providers are involved, n number of different steps are involved, and I would love to discuss those steps with you. So let's try to understand whatever we have studied till now. So this is the first point. What is primary market? So primary market is a part of capital market where buyers and sellers, they engage in trade of financial securities. That could be bonds, that could be shares, etc. It deals with the trade of new issue of shares. New issue means the shares which are issued by the company. The shares which are directly issued by the company, or the securities which are issued by the company, and this is regulated by SEBI because the entire capital market is regulated by SEBI. Now, sir, how can you issue the new shares? The first is issue the new shares with the help of, I'll start with the term IPO. I'll start with the term IPO, that is initial public offering. Initial public offering means when you issue the shares, when you issue the shares directly to the public, and generally this issuing is done with the help of a financial institute, or in these days it is done with the help of the stock exchanges. Second one, we have offer for sale. So offer for sale means in this case company will issue these shares to the intermediary. It will issue the shares to the intermediary. Now intermediary will purchase the shares from the company, and then this intermediary will issue the shares to the public. But here price will be decided by the company. Here price is decided by the company, but here price of the share will be decided by the intermediary. Next is private placement. So private placement comes in two forms. One is it is witnessed in case of a private limited company, and even in case of public company. If you want to go public but you don't want to issue the shares openly to the public, you can issue huge chunk of your shares to the qualified institutional buyers, the ones who are qualified to purchase huge volume of shares directly. Next is right issue. So right issue means when you are issuing the share with a right. Issuing the share with a right means, right issue means you are issuing the shares, but you come up with a term. That these shares will be available, or these shares can be purchased only and only by the employees of the company. So that is known as right issue. Now someone is asking me, so what is the difference between IPO and FPO? I was about to discuss, but no worries, first I'll discuss that only. Let's suppose I talk about a company, and this company is issuing the shares for the very first time. Issuing the shares for the very first time. So when company is issuing the shares for the very first time, that is known as IPO, which we call it as initial public offering. Okay. Now let's suppose I talk about, let's say, Zomato. So Zomato has issued the shares for the very first time in 2023. I'm just taking an example. I'm not giving you the exact dates. I'm just taking an example. So let's suppose IPO or Zomato has issued the shares for the very first time, and that too in 2023. After 5 years, now company wants to liquidate their equity further. For example, I am one of the co-founder of Zomato, and I have, let's suppose, 10% of the Zomato shareholding. The moment shares have been issued to the public, they are in circulation in the public, they are in circulation in the trade, in the secondary market, their market price has increased. Now I decided that I should liquidate my asset. If I decided that I should liquidate my asset, and now company is directly issuing the shares once again, we call it as follow-on public offering. So what is follow-on public offering? So follow-on public offering can be remembered in this method. Follow, F for follow, F for familiar. F for follow, F for familiar, I for initial, I for introduction. So when company is introducing itself for the very first time to the public with its shares, that is known as IPO. But once the IPO has been issued over the period of time, then company may decide to liquidate further, and that will be termed as FPO, follow-on public offering. Now if company is issuing for the second time, or maybe for the third time, or maybe for the fourth time, for that matter maybe for the 100th time after first, it will always be termed as what? It will be always termed as follow-on public offering. You might have heard Coal India Limited. If in the budget government announced that we are going to disinvest 10,000 crore rupees in Coal India Limited, and we will be going through public issue. This means Coal India Limited is going to issue their shares directly to the public, but Coal India Limited is already a public company. Shares of Coal India Limited are already circulating in the market. Many of you and me, we already have purchased these shares. That means no IPO this time. If they are issuing the shares in the market openly to the public, that will fall under the category of FPO, follow-on public offering. Is it clear, everyone? Let's suppose after 20 years, 50 years, government decided to issue the shares of RBI. So if the shares of RBI will be issued to the public for the very first time, then it will be IPO. And after 100 years, government wants to liquidate more of its shares in RBI, then it will be termed as what? So then it will be termed as FPO, that is follow-on public offering. Is it clear, Maulik? Is it clear, everyone? May I have yes, sir, in the comment section, please? Is it clear, everyone? May I have yes, sir, in the comment section, please, so that we can move ahead. Quickly reply in the comment section. Clear? Got it? Chalo. Now let's try to learn few terms related to initial public offering. First term is underwriter. So what do you mean by the term underwriter? So it's a financial service provider. It's an intermediary company which is providing this service, but let's try to understand this. For example, the same, I'm going back to the same story. X Limited tied up with SBI and asked SBI to please issue its shares to the public. Now X Limited also comes up with a condition that, sir, in next 3 months, we have targeted to raise 50 crores. We have targeted to raise bare minimum 50 crores and we want you to underwrite. We want underwriting from you. What is this underwriting? This means SBI will underwrite. SBI will say, SBI will sign an agreement that if in next 3 months, SBI will not be able to issue the shares of 50 crores to the public, then don't worry, 50 crore rupees of shares will be purchased by SBI. So that guarantee is known as underwriter. Earlier, in the early days, underwriting was a practice which was mandatory and it was made mandatory by SEBI, but over the period of time, SEBI has obviously, I would say, ease out the market, and in order to increase the IPOs in the market, this underwriting norms have been diluted a lot in the past few years, and that is the reason a number of IPOs are coming on regular basis. Got it? So what is underwriting? Sir, underwriting means when a person or a company guarantee the company that I will be purchasing the minimum decided value of shares if these shares will not be purchased, if these shares are not subscribed in the market. That is basically termed as what? That is termed as underwriting. Clear, guys? Second, merchant banking. Yeah, merchant banker. What is merchant banker? Guys, I am a businessman. I have founded a company. Let's say I founded a restaurant chain. Now I want to go public, but I don't have any knowledge about this market, SEBI, norms, register of company, private limited, public. I don't know anything. So what I'll do, I'll hire an individual or a company or a service provider and I call it as my merchant banker. Now, who is merchant banker? So merchant banker is the think tank of a company which tells the company when to issue, how much to issue, at what price to issue, and through which mode you should issue your shares. So all those decisions from day one, when the company is set up, till the last date when the company is liquidated, all the decisions related to the shares, their issuing, their volume of issuing, their price of issuing, all these decisions are taken obviously by the company, but recommendation comes from merchant banker. So merchant banker is one. So he is the think tank who is engaged in the issue management business, decides selling, buying or subscribing the securities fit in the situation. Eligibility, who is going to be termed as merchant banker, must hold a certificate which should be granted by SEBI, and if you have that certificate, then only you will be termed as merchant banker, and then only you can provide these kind of services to the companies in the market. Moving on to the next point. The next is banker to the issue. As I said, SBI. So I am a company, I tied up with SBI, and SBI is not only issuing my shares, but it is also doing n number of operations on my behalf. So who is the banker of issuer? SBI. So banker of issuer means the bank who is going to perform functions or n number of services on the behalf of the company is known as banker to the issue, or banker of the issuer can be said. And in this particular case, generally the scheduled banks, they are appointed as banker to the issue. The next is registrar to an issue and share transfer agent. Registrar to an issue means the moment I decided that I will be issuing the shares to the public, I will ask the public to submit their application. The one who is going to collect those applications from the public is known as registrar to an issue. So he is going to register the applications who all are interested to purchase the shares of my company, that is known as registrar to the issue. Once the shares are allotted, then there is an organization which is going to transfer those shares to the one to whom these shares are allotted. That will be termed as share transfer agent. That will be termed as share transfer agents. Is it clear, everyone? These 2 points are clear. So registrar to an issue is responsible to raise the applications, collect the applications. Once the applications received, shortlisted, then those who are selected that yes, you will be getting the shares, then the company or the organization or the financial intermediary which is going to transfer those shares to the one who have been allotted with those shares, that company is termed as what? That company is termed as, or that financial intermediary is termed as share transfer agent. Now, what is the benefit of primary market? The benefit of primary market is the first one. Let's suppose you and me, we want to purchase a new car. And if in order to purchase a new car, we go to the Maruti Suzuki showroom. Now you and me will purchase the new car at same price. So this is the first benefit of primary market, that in case of primary market, all the investors, they get the shares at the same price. Second is, it is safer for investment as there are lower chances of manipulation of prices. But in case of secondary market, these things may change because there could be manipulation. If you are purchasing a second-hand car, there could be a number of manipulations and the price may differ. That is not the case in case of primary market. Terms related to primary market, the first term is going public. What do you understand by the word going public? Going public means when a private limited company is allowed by SEBI to issue its shares openly to the public. That means company is now going to be a public company. That format is known as going public. So it is the conversion of private into public company is known as going public. Second is, what is red herring? If you remember, I mentioned this term, red herring prospectus. What is this? When a company wants to go public, company will come up with a proposal to the SEBI that this is our company, this we have done in the past, this we will be doing in the future, and we want you to allow us to issue the shares. This is the share price we are expecting to earn or to receive. This is the capital we are expecting to receive or raise, and this is the overall capital of the company. So that entire proposal which we submit or which a company submit in front of SEBI before they get the permission to go public is known as red herring. What is market share? So market share is defined in two forms. First is in terms of revenue and in terms of units. For example, let's say Infosys. Sir, Infosys holds 10% of the IT market share. Now 10% in terms of revenue. That means if overall IT market or IT industry in India is receiving a revenue of 100 crores, that means 10 crore is received by Infosys. On the other side, Apple. So Apple is having a market share of 30%. That means if 100 phones are sold, then out of 100, 30 phones are of Apple brand. So this is known as market share. So market share can be defined on the basis of units or on the basis of revenue in the market. The next point is market segmentation. So what is market segmentation? Market segmentation means when you divide the market so that you can find out the target audience. For example, if I want to start a new business, let's say I'm opening up a new restaurant. What I'll do is, let's suppose I'm opening up a restaurant and I first want to target my nearby premises. So if I am coming up with a veg restaurant, so first of all, my target market will not be all the nearby residents. My target market will only be the veg residents. Then my price bracket is 200 rupees per person, so I will be leaving all that population which is not purchasing or which is not buying the food for at this particular cost. After that, once I have got those targeted market or the number of buyers who are capable of affording 200 rupees per person and they are vegetarian, then again I'll figure out how many of them do not prefer onion and garlic. That means I'm not serving jam food or I'm not serving that food, so I will be excluding them. The left out part who eat garlic and onion, and I will be targeting them, keeping in mind my price bracket. That is my price, that is my target market. That is my target market. So when we find out the market or we find out the target audience to whom we are going to issue our product, to whom we are going to pitch our product, that is known as market segment. The last one is contango. Contango is a scenario wherein the price of a commodity in future market is higher than the price of sale. I'll discuss this when I will be talking about derivatives. It is irrelevant right now. I won't be able to explain this in this particular session itself. Is it clear, guys? We won't be discussing secondary market because I have a next session at 9 p.m. But I guess primary market is clear to you. Now you have an idea how Paytm issued its shares, how Paytm come up with the term IPO, how Zomato come up with the term IPO, what is the process, what all financial intermediaries are involved, how can you apply for a share, what is ASBA, application supported by blocked amount. I hope these basic formats are clear to you. So primary market is a place where company is an issuer and public is a buyer. But in case of secondary market, company has nothing to do, company is out of the picture, public is selling and purchasing the shares within themselves. That is known as secondary market, and I will be discussing secondary market in my next session. Before I conclude, could you please tell me how was the session? How many of you have learned that how companies go public for the very first time? How many of you have learned the term issue capital for the very first time? For that matter, subscribed capital for the very first time? Who all of you have learned these terms: IPO, FPO, public issue, or I would say right issue, or for that matter n number of terms like red herring, going public. If you have learned these terms for the very first time in this session, please give me yes sir, and I will be concluding the discussion over here. And today at 9 p.m. I will be discussing a very important concept on Testbook application. So do download Testbook application and choose the category regulatory bodies under super coaching, and then join my masterclass at 9 p.m. where I will be discussing again a very important concept related to basics of finance bucket itself. Is it clear, everyone? You all have enjoyed the session? Okay. Only one individual find it great. What about others? What about others? I hope you all have liked the session. I hope you all have liked the session. I hope you all have shared the link of this session with your friends. And if you have enjoyed the session, you like the session, do reply in the comment section. If you don't want to write a long sentence, just give me a thumbs up, or you can just give me a heart sign in the comment section so that I can get to know that yes, you are learning good. I'm learning the content for the very first time. Thank you Kunal. I hope you all have enjoyed. We'll catch you in the next session. Bye bye, good luck, God bless you all. Bye guys, see you at 9 p.m. on Testbook application. Bye bye.